Thanks, everyone. Thank you all for coming today. It's great to have so many people out. So I'm going to talk a little bit. My presentation is the 2012 review and 2013 outlook. So. Basically, I'm not going to say a lot about what's happened so far in 2012, other than to say it's still been an active and exciting year in the marketplace. It hasn't been as volatile as last year, but that being said, there have still been some fairly large swings in the markets, particularly over, if you've been looking over like a couple of months time frame here and there, markets have moved quite a bit, and we're not done yet. There's a lot of things that could still happen between now and the end of the year. There's still lots of time for markets to move and for volatility and for trading opportunities. The big thing that was really overhanging a lot of sentiment and discussion over the year was the U.S. election, and that's now over. And now the focus is getting back to work on what they call the fiscal cliff, which is that in the United States they have a whole pile of tax increases and spending cuts that are set to come in at the end of the year, unless they come up with some agreement to change it or to stretch it out over a longer period of time. And basically, it's in both sides' interest to make a deal, but the markets have actually started to rebound on the last week, particularly with comments out of the Republicans saying, "Okay, we realize we lost, and that maybe we'd better be a little more agreeable than they have been the last couple of years." So we'll see what happens. I mean, it's always negotiations, and people will posture and everything else. But at the end of the day, it's in nobody's interest to not make a deal. If they mess up and mess up the government, or their credit rating or anything else, it not only does it look bad on both of them, but at the end of the day, the Democrats have projects that they want to fund, the Republicans have projects that they want to fund, and if they don't come to some sort of a deal, nobody's going to get anything that they want. So it does behoove them to do something at some point. But
is this presentation available online, or do we start making notes?
we're recording it, so it will be available later on our YouTube channel. So, but that being said, while we're getting there, as we will recall from last summer, it's not always that easy a road to get there. And because of that, it may keep markets choppy. And the seasonal rally or the Santa Claus rally that we usually see may get delayed a little bit because of some of this uncertainty. Another thing to watch for is tax loss selling season. It normally means people will sell their losers to try and mark them off against their winners. But what's happening this year is a lot of people are selling their winners, and in particular you're seeing that in Apple and Google and some of the other stocks that were up huge in the first half of the year. And the reason is because part of this set of tax increases is increases to capital gains taxes and dividend taxes. So people are saying to themselves, well, if I'm going to sell now and pay a certain level of income capital gains tax, but if I wait till next year and I have to pay more tax, well, then maybe I'll sell now, pay at the lower rate, and then get back into my position later on. And I think that's what you're seeing, and that's probably one of the reasons why you've seen Apple come down in particular and Google so much in the last few weeks. On the fiscal cliff, the other reason why it's been overhanging the market is because even though there's a small chance of failure, the price of failure if somebody miscalculates is very high, because you would likely see a U.S. recession and a credit rating downgrade. Both Moody's and Fitch have basically threatened already to downgrade the United States if they don't come up with something reasonable. Switching now, so most of this is obviously Europe is still the United States is still a big driver in the marketplace through the rest of this year. But of course, we can't forget about Europe. Greece is likely to be dealt with within the next few days. The general feeling is that sometime within the next week or so, they should come up with some sort of an agreement to deal with their funding going forward and give them some extra time to sort out their problems. Once that happens, focus turns to Spain and also turns to Cyprus. Cyprus is next. Their bailout negotiations are underway. Again, should get settled within the next few days. Focus eventually turns to Spain. Tomorrow there's a regional election in the Catalan province, which could create further uncertainty because the Separatist Party is leading in the polls. The last thing is they may or may not get a majority of the seats in their parliament. And as we know in our experience here in Canada, the election of a separatist regional government doesn't necessarily mean the country breaks up, but it does create uncertainty, and with a country that's having as many problems as Spain is right now, it certainly doesn't help their situation. The interesting one is China has been showing signs of a rebound. And if you look this week at the data, the leading indicator came out on Wednesday, and the flash manufacturing PMI, the preliminary number, came out on Thursday, and both of them were their best readings in about a year. So things China has been slowing down for the last several months. It's been dragging down commodity prices with it, and other markets. It looks like it's starting to stabilize now, but it's still a little early, but we're certainly watching for the signs of bottoming here are starting to look a little bit more encouraging. If it does pick up, it's changing prospects can influence trading in copper and the resource currencies, whether it's Canadian dollar, Aussie dollar, New Zealand dollar primarily, and also the national indices as well. Looking forward now, the Hurricane Sandy is another big one that's likely going to play out in economic and corporate data over the next few months. So we've already seen some of the U.S. data has been getting impacted by it. We saw a big pop in jobless claims, and some of the regional numbers have come in quite disappointing. And don't be surprised if that kicks through over the next couple of months. Longer term, however, it can actually give the economy a boost because people will be going back and rebuilding and reconstructing and making things better and building barriers and so on. So that actually, in the longer term, actually ends up being good for the economy. Short term, you'll probably see some weak numbers out of the States. But at the same time, also note that when we get the next set of earnings results, likely, as it is, most companies will use the fourth quarter to take any write-downs that they possibly can, knock their income down and their taxes down, and set it up so they can look good next year. Well, I would say this year, any company that is going to be humanly possible that they can find any write-down that they can blame on the storm, they will. I am sure that there will be some company that does only business in California that will find a way to blame a write-down on Hurricane Sandy. It's the way of the world, and that's how companies do things. The Mayan calendar rolls over on December the 21st, which is supposed to be a time of change and what have you, and whether anything happens or not remains to be seen. But the most important thing is this: markets trade on psychology, and oftentimes there's been a rally in markets around the middle of December. Again, that's the kind of thing that these kind of things may delay things a little bit. We may still get our Santa Claus rally or our rebounds, but instead of early to mid-December, it may end up being the end of December. It could even slip into January, depending on what happens with things like the fiscal cliff. The other thing to keep an eye on is the drought trade in grains, the corn, soybeans, wheat that all took off in the summertime. That whole trade's been unraveling now that the harvest is done and people are looking ahead to next year. So now moving forward and looking ahead to 2013, I'm calling next year the Fed versus history. And it's going to be a very interesting year to see how there's a couple of major themes and trends and cycles that are going to be going head to head against each other, and we'll see who wins. So on the bearish side, we have traditionally the year after a presidential election, year one of the cycle, is traditionally the disappointing and oftentimes can be one of the worst years. And the reason is because usually the presidents do the most unpopular and contentious things at the beginning of their term, hopefully hoping that people will forget by the time the next election rolls around. And the second thing to watch for is this: regardless of what happens with the fiscal cliff, some sort of deal, whatever comes of it, is going to raise taxes or cut spending in some magnitude, whether it's more of one or more of the other or what have you. But at the end of the day, you are talking about negotiations on austerity packages, which is the same thing that's unraveled Europe in the last few years. Now, the United States, the goal in the United States is obviously not to drive their economy into the ground. It's just to they're trying to aim for some sort of soft landing for their budgets so that they don't go bankrupt. But at the end of the day, though, it could curb economic growth and it could weigh on stocks. One would expect, all else being equal, that austerity fiscal policy would slow things down and cut corporate earnings outlooks and what have you. So that's on the one side. On the other side, you've got this incredible amount of money being pumped into the US financial system with QE3 coming from the Federal Reserve Board. And it's not just them, it's the Europeans are buying bonds, the Bank of Japan is looking at more stimulus, and because of that The thing is this, when you put more money into the system, it takes a while to work its way through the banking system and to be lent out and to find its way into Main Street. What ends up happening with this money first is that usually the fastest and path of least resistance is to find its way into the stock market, to find its way into commodity markets. And it pushes those values, and it ends up inflating stocks and commodities and other asset prices. So you've got this fiscal slowing on the one side versus the monetary stimulus on the other side. And the first half of next year is going to be about who wins this battle. And it remains to be seen, and it's up in the air at this point. But what you will probably end up with is a fair amount of volatility, some swings in the market, not huge, necessarily massive intraday swings, but big enough swings that people can trade and take advantage of. I'll just note, by the way, while I have this up, all the tables in the presentation are courtesy of CMC Markets with underlying data from Bloomberg. The other way of looking at the markets is what I call the risk pendulum. And you'll probably see reading from various comments about risk on and risk off, and risk goes on and risk goes off. And some days it's like turning a light switch on and off. It can go fairly quickly. And what it's all about is the idea that when people get scared, they go into defensive plays, and when people decide, okay, well, maybe we were a little bit too nervous and too scared, so okay, fine, now we can go back and trade in our regular markets. So what tends to happen is that during times of optimism and decreasing fear, you'll have more of a boost in European currencies, which is like the pound and the sterling and the euro and the kronas and things like that. And then the resource currencies, which is the dollars, the Canadian dollar, the Australian dollar, the New Zealand dollar, there's the Swedish krona and so on. And then stocks, of course, tend to benefit from that, as well as copper and energy commodities, the more cyclically focused ones. During times of pessimism, when people are scared and think, oh my God, the financial system's going to unravel again, or we're going to have some kind of crash or whatever, then people, what happens? They go running into U.S. treasuries, and that just also boosts the U.S. dollar. Also, they've been going into the yen and the safe haven of last resort, gold, silver, platinum, the precious metals group. So when people are encouraged about things, they go into what we call the risk markets, and when they're discouraged or scared or nervous, then they go into the defensive plays. So I will talk a little bit now about some of the longer-term trends in the marketplace. Actually, one thing I'm going to do just before I do this is go back. I wanted to talk about the Japanese yen for a minute here, which is, and I'll speak to this a little more at the end of the presentation. The yen has been under a lot of pressure lately. It's been falling against all the major currencies. The reason is there's an election coming in Japan on December the 16th. It's expected that there may be a change in power. If the change of power does happen, the party coming in is expected to increase fiscal stimulus and monetary stimulus. Higher inflation targets, more quantitative easing and things like that, and more spending, more government support on the fiscal side as well. So that has ignited the Nikkei and has put pressure on the yen. So keep an eye on that. If something happens and these things don't come about, you could see a reversal at various points. So the Nikkei and the yen likely to be very active right through to the end of the year. Long-term market trend. This is a chart that I've used before. I think I know some of you will be familiar with. This is the pink line is the market from 1965 to 1984. And it was the last what we called an inflationary bear market, which basically means that the stock market goes sideways for years on end, but on an inflation-adjusted basis, you end up losing money. And that's the kind of market we were in, particularly through most of the last decade. There were two generational bear markets. This was our parents' generational bear market here in the 1970s. This is the current generational bear market here, 2007 to 2009. Recovery patterns were very similar, but in the 70s where the market corrected, our markets this year kept on going. Quantitative easing, for one thing, has been propping these things up quite a bit. So we could be due at some point for a return back to trend, but as long as the Fed keeps pumping money into this system, we may stay up a little bit higher. This chart's a little busy, but it's the presidential cycle and the impact on markets. So most significant up here, The average return during the years, year 1, 3.7%, year 2, 4.4%, year 3, 13%, and year 4, 6.6%. This goes back to 1928, and so clearly year 1 has tended to be the weakest year in the cycle. If we look down at the business cycle, here, these are the cycles since the 1980 election. The most similar here was this cycle after 2008 was most similar to the years after 1984. 2 years of double digits, a correction, and then a nice finish. 2 years of double digits, a correction, and it looks like we'll be heading for a reasonably good finish here as well. So in terms of economic years, you'll find the cycle this time around after 2008, most similar to after 74. So 2 years of big gains and a correction, 2 years of big gains and a correction, and then a rebound. In their case, they didn't have much of a rebound in year 4. They had a better one in year 5. This time around, we had a good rebound in year 4. So if we spread that out over a couple of years, we may be looking at moderate gains in the indices next year. You might be looking at high single digits looks possible for next year overall. Looking, however, at the impact of quantitative easing on the U.S. markets, what this chart basically shows, first of all, usually before the Fed brought in their previous money programs, we had markets were down a lot. And these things were brought in as emergency measures. The QE1, the market was down 17% the month before they brought it in, down 25% in the 2 months before they brought it in. It was, in this case, however, by QE3, the markets were actually up in the months beforehand. So it's a much different environment this time that the Fed has come in with QE3. And after the program started, because these were brought in as an emergency measures when the U.S. economy was going through a rough patch, you found that the lag, there was a lag before the support really kicked in. So markets stayed negative after the launch of QE1 for a while and then picked up. But what you start finding, though, is that as you went forward, by 3 months, by 6 months particularly, and definitely by a year, you can see the positive impact seen from this printing of money, that the markets have ended up posting double-digit percentage gains in, but it's taken a while to get there. So the Fed brought in QE3 back in September, so it's possible it could take till February or March before you start to really see the impact of that kick in to the stock markets. However, the one thing you've got to watch out for as traders is when they eventually end this, because eventually the U.S. economy will get back on its feet and grow. And when it does, look out, because every time, because as I've said, the QE programs and this fast, quick money ends up artificially inflating prices. And because of that, when they take it away, the markets tend to come back down and you end up with a big correction. So in the 2-3 months afterwards, double-digit losses in the market. So if the Fed pulls a plug on QE3 or even possibly on the twist, watch out, because you could be due for basically a normal correction, a retrenchment afterwards. And that's just based on the changing outlook in the money supply.
Does the Elliott wave have anything to do with this? Do you ever use it?
I personally don't use it. There are lots of people that do and swear by it, and they would be the best people to talk to, because I don't really follow it. My feeling on indicators, by the way, while we're on that topic, is use whatever works for you and you're comfortable with as a trader, and that's the most important. So there are some people that love Elliott wave. There are some people that hate it. I personally, in my work, I tend to stick to more traditional indicators, moving averages, pattern analysis, MACD, RSI, and things like that. But that's what I use, and that's what works for me. I used to, when I was a broker, so I'd sit there and do this, and my friends that sat right beside me would use point and figure charts and point and figure charts and stochastics, and that worked really great for them. So whatever works for you and you're used to and you get comfortable with is the best system. And the one thing I do say is keep it reasonably simple and don't try to get too complicated, because that's when you can start to run into problems. Looking at the average performance of indices with QE, quantitative easing programs, is, again, this is a number of markets around the world, the Dow, the FTSE, the Nikkei, Toronto, Aussie, and DAX. And just what it shows is that on average, when these programs have been brought in, the markets have lagged first, but then by the 6-month mark, most of them are positive. By the 1 year, most of them have been quite positive. And again, after these programs end, double-digit percentage losses across the board in the 3 months after a QE program was called off. So watch out if they when it comes to an end, and it will, because they're not going to print money forever. The next thing is looking at currencies. And what's most important about this one is that overall, the impact on the European currencies is pretty much non-existent, the pound and the euro. It's had a bit of an influence on Canadian dollar and Aussie dollar by the 6-month and the 1-year range. And the reason for that is, of course, those are export economies. They're sensitive to commodities, energy, and copper, and things like that. And I'll talk about that on the next slide. But when they've started to go, they brought the resource currencies along with them. Where QE really has had a big effect, and the most immediate, is on gold and silver, the precious metals. The idea of printing more money and devaluing paper money is rocket fuel for the precious metals. And you'll recall, even when the Fed did announce QE3, gold and silver took off. Then they had their big correction. And it was a seasonal correction, and it was normal. And now they're starting to move again. And why? Because this it just has been known to totally ignite the precious metals. And in both cases, QE1 sent gold taking off. QE2 sent silver to that $50 retest of the 1981 highs. So it's as I say, it really does light up the precious metals. It has in the past. 3 months, 5%, 3%. By 6 months, 10%. Big double-digit gains. By 1 year, again, big gains in gold and in silver historically with the QE programs. The commodities are similar to the stocks. You have a bit of a lag, and then by the 6-month, 1-year mark, you've been looking at double-digit percentage gains for copper, crude, and gasoline. And what's most interesting about this is if you take these first three, they're more sensitive to the global economy in terms of driving their prices. If you look at the second three, natural gas, wheat, and corn, they're more sensitive to weather, and funny enough, there's no impact from QE on their prices, which makes sense because they're more sensitive to changes in climate and other things. So it does make sense. It's important when you're looking and doing studies of things, of not only looking at, okay, this is what works, but it's also good to know this is what doesn't and why. And that helps to reinforce both sides and can help with understanding why and how things work. I'll talk a little bit about seasonality in the markets. I did a study of 25 years of seasonality, and I include this in our monthly videos as well, which can help people take a look at. So generally speaking, in terms of the stock markets, and in this case I'll talk mostly about the Dow, that it tends to have a pretty good finish to the year. October, November, December are usually fairly strong. And the beginning of the year, January through about May, is also a good time of year for stocks historically. And among the reasons for that are, as we discussed, the rebound from tax loss selling, optimism about a new year, but also in many countries around the world, the first half of the year is investing season. That's when we do our RSPs here in Canada, and that's when other countries also have their time when you can invest your money into the retirement programs and gain the tax benefits. So that's why you tend to have a lot of demand and interest in the first half of the year. June tends to be a correction month for a lot of markets. July tends to get a rebound, and August, September, and the first half of October are usually tough, and then a strong finish to the year. This year, clearly, we had a lift in the markets in September on the QE announcement. We then have had a correction in October and particularly in November, and we're just starting to come out of that. So it seems as though this year the seasonal impact may be delayed a little bit because of the factors that I discussed a few minutes ago. When we move to commodity markets, as I noted, gold and silver had a run in September and a correction in October. That's actually fairly typical in terms of their seasonality. Then November, December, January, February tend to be very good for precious metals. Silver can even carry that a little bit farther. Not only do you get, as I talked about, the general investment demand interest, but of course also it's wedding season in India, which is particularly important for jewelry demand in the gold market, and that drives a lot of the seasonality in gold. In the copper market, copper's in the weaker part of the year here, running August through December. Its stronger time of the year tends to be January through April and the beginning of the summertime. Crude oil is coming out of, it's nearing the end of its weaker part of the year, October through December. And crude tends to have its strongest time of the year between February and about July, August, even September. February, say, through September tend to be stronger for US crude. Gasoline is driven by, primarily by driving demand in anticipation of driving season, which in the Northern Hemisphere is in the summertime. That's when people go on road trips, people go to the cottage, people go driving for vacations. And we obviously don't do that as much in the wintertime. The weather's bad and nobody wants to go driving too far in the wintertime. So what happens is that gasoline demand is, as such, it actually looks ahead. So the weaker time of the year for gasoline tends to be July through about November, and then it tends to have its stronger season December running through to about June. Natural gas is a little bit different. Its peak time of demand is in the winter because it's used primarily for heating homes. So although we're starting to see some of the chemicals demand start to come back into natural gas because the price has been low for a while. But best months of the year for gas are usually September and October. It then often has a correction between November and about February. It's had a correction through November. It's starting to bounce again more recently. And another stronger time for the year for natural gas tends to be March, April, May, when the people look ahead to the summer and cooling season, because natural gas is used in power plants, and there's more power demand in the summer for air conditioning. Wheat and corn tend to be mixed throughout the year, but November tends to be a soft month for them. December has tended to be fairly strong for them, and then the wintertime tends to be somewhat mixed. What's interesting here is that June tends to be a negative month, December tends to be a positive month. I think you end up with some rebalancing and repositioning at 6-month timestamps, it seems.